Good morning and welcome everyone. This is John. Happy St. Patrick's to everybody out there. Everyone's Irish today, as they used to say. And if you click on the link in the room, you will get our weekly trade sheet. And we like to start our day off. We do this every day here in the room. But for Mondays, we do planning and scanning. Take a look at what happened last week and what we expect for this week and what the overall condition of the markets are and what possible trading opportunities we have. So that's the purpose of planning and scanning for the week. First off, our daily positive thought, just do it, was from a Nike commercial. So just do it. What is it? Whatever it is, you just do it. If just commit yourself to doing it. So if it is only taking high probability setups, then just do it. Don't change or alter or anticipate a signal, just follow the rules. If it means follow the trading rules, then just do it. Bottom line, just do it. And that's how I relate to today's daily positive thought. Just do it. Just follow the rules, and if the trade has merits and if the setup has merits over time, that's the setup that will create a positive performance over time. Remember, not every trade's a winner and not every setup wins, bottom line. But if you have the proper risk management technique, then if the trade doesn't work, then you're going to be out of the trade. Typically, you're going to be very glad you placed a stop if the trade doesn't work. And I'm more focusing on the trade not working because damage control is literally the key to success in the business. If the trade has merits, then you will be rewarded. And if you just wait for the right setup and if you act accordingly rather than hesitate. So in other words, if you're looking at a trade, find out everything there is about that trade, stalk that trade, follow through with that trade, and then when it's time to place the order, you won't be hesitating, finding yourself doing something else or mentally sabotaging yourself. Just do it. Anyway, for today, it is St. Patrick's Day. So, as we used to say back, I think, well, I didn't invent it, but someone did probably back in the 60s or the 70s, happy St. Patrick's Day, and Aaron go braless, but I don't know. But in Chicago, apparently they were able to paint or dye the river green, and it was a fairly warm day for them, comparatively speaking, since they've been below zero. So Chicago's St. Patrick's Day parades were wonderful. Down here in Florida, I understand, I was not there, but I understand there was a great little St. Patrick's Day over in Singer Island near where HGSI Doc lives. Anyway, for today, we have Empire State Manufacturing Survey, which has already been out. Industrial production comes out in approximately 12 minutes. Then we have the Housing Market Index at the top of the hour, 10 a.m. That's for today. Notables for the week. Do be prepared for that Tuesday. Housing Starts and Consumer Price Index. And I think the front seat, besides what's happening in Crimea, Russia, Ukraine, is taking forefront. But also keep in mind, here in the United States, Wednesday's FOMC announcement is at 2 p.m. And that should be not a 7, it should be an and. And so the press conference is at 2:30 p.m. If you look on your keyboard, you'll see that if you hit Shift capitalized, the and sign is above the 7, so that's why there was a 7 there instead of and. Sorry about that. Thursday, we have existing home sales and leading indicators, and notables for the week, of course, it is quadruple witching. Earnings for today, supposedly before the market or during the day, Avid, CTIB, Perry Ellis, and Rand Financial. Those are some of the lower end stocks as we are concluded with the bulk of earnings season, but we still have a few names that come out. In weekly high close dojis, a lot of names came out in the energy sector, specifically utilities and electric utilities. FE, NRG, PPL, we'll come to those names in a few minutes. Low close dojis, you may recognize some of these as also energy, like CNX, which is console energy, but it's more consumable gas and coal. So ISRIG, everyone knows what Intuitive Surgical is, Oracle, weekly low closed doji there. So I think it's fairly notable to look at to see when we look at whether or not we have high closed dojis to find out if we are in a seasonally strong period of time or seasonally weak period of time. We are entering a seasonally strong period of time for utilities for the most part. Even though it's not here, I should probably put that because it is not an entire sector. It's only certain specific electric utilities have a seasonally strong period of time, and that's why I did not put the XLU in there, which is the utility sector. So we got to be a little bit careful when we look at certain utility stocks. So with that said, we still have weakness in drug stocks, biotech, the IXTC, which happens to be the telecommunications sector. Bonds actually stay relatively weak until about on or before tax date, April 15th. The euro, gold, and silver are not behaving seasonally weak, so we can't imagine what's going to happen when they enter a seasonally strong period of time. Cattle prices, which have not backed off, but they are in a consolidation range. Coffee, sugar, bean oil, and wheat. Bean oil did give us a heck of a short position, and if you had been following that, something that we'd been discussing in this room for a little while here. So let's take a look at what happened in the market. We did get follow through last week in the downside. Last week we had a lot of rollover within the futures markets. So when we take a look at what happened here, we did not really generate any new buys, new sells on a daily basis. As you can see, I'm looking across the spectrum of the market. A couple things I wanted to quickly go over with you is the fact that when we do these rollovers, you have discounts, premiums, disparities, and charting packages will change from the front month, which would be sometimes the December contract, and then they immediately roll and plug in the new contract, which can be harmful or give you a different sense of valuations. And it can alter and change algorithmic buy and sell signals. So you have to change and work out those differences, and by doing so, you have to go back and change all your settings to the new contract so it doesn't show old prices overlaid to new prices. So with that said, the knob spread, we have a potential for we have the potential, it's a double negative, but we have a great situation developing in the fact that we have a potential double top in the market. For the knob spread, once again, I've got a 240, which is a 4-hour chart period. What I'm looking for here is I'm looking for the knob spread itself, and probably this is a trade that's going to be all or none, meaning it's not going to do anything until after Janet Yellen says what the Fed plans to do after in her press conference. Remember, the Fed has been buying treasuries, and that infuses liquidity. Are they going to taper? Do they see the need to taper right now? I mean, she saw some notable weakness in the economy in front of the Senate Banking Committee last time around. She noted that there was some inherent weakness in the markets. She did note that there were some strains in the economy on a global scale. She's probably got her eye on China. Certainly, she's not blind to what's happening into Russia. So I don't know if they're going to be really willing to cart at this point in time. And so that's one of the things that is going to have an impact on bond prices this week. If there is a continuation, I mean, I think that, because we have a seasonally weak period of time, if she does not cut back on tapering, the stock market will be happy, and you might get a sell-off here. I think the key is to watch the 240-minute, as well as my other favorite time frame is to look at the 60-minute chart, not the daily, because the daily will not give us enough. But as you can even see with the 60-minute chart, if you're interested in the knob spread, not from from both the perspective of trading it, as well as the perspective of looking at for signs to clues of turnarounds in the market. So if we do break this stronger uptrend, and if this overhead resistance line that I've drawn in the sand tends to hold the market, so you'd have a potential double top in the market here. As you can see, potential double top in the market, but you have to break that trend line, and I really wouldn't be interested in selling, even though I know from 823 to 8 is a a sizable move. It's approximately $750 move in the spread. I would be more interested in having it break below the 8 level and break below this swing point. As you can see, it's been pretty instrumental. So it needs to get not only underneath that trend line, but underneath 8. And then I'd be interested in taking a short position on the note to bond spread. And what you would do is you'd sell bonds and buy notes. But if you get that market and you don't want to trade the knob spread because you don't have enough information, or you don't know what the risk is, or you don't know the tick value or how to put on a spread, by looking at the one of the things that we'll be discussing in the room this week is be watching this spread relation, because obviously if the Fed is interested in continuing quantitative easing and they don't taper this time around, there's 6 more weeks before their next meeting, and what that means is you probably have an opportunity to get the market back down into minimum objective $7 again. So a trading range, in other words, and that's a nice move. So that's the story with the knob spread. Now let me change my pages over here, and let's take a look at our advanced decline. Our recent analysis, my longer term analysis, folks, is that I believe that the market, even though we need to be vigilant in anticipating that at one point we're going to see a correction, my longer term work, as you can tell, we don't have any, the only thing missing on the bottom chart here to get very bearish in the market is there's no orange triangles. If we take a look at the S&Ps in essence on a longer term basis, we didn't even close below the weekly lows. We don't have a weekly sell signal, and the market is, and again, this is a rollover, so let's take a look at the rollover, meaning these prices were comparing the March contract to the June contract. So here's the cash market, the spiders. So you take a look at the spiders, one of the things that we note is that, boy, we didn't even break below the moving average on the advanced decline on a weekly basis. So we don't even have a longer term sell signal. What we potentially have is, in this week being quadruple witching, is a potential top process where the market just doesn't go straight up and then straight down. It's a process. It goes back and forth. But one of the things that we noted, and our theory is that we're going to see a sector rotational correction, and that the market will grind back and forth as the market gets out of certain sectors and starts to load up on other sectors. And we will see, I think, one of the names that we had mentioned in prior weeks is that what weighs on the NASDAQ is biotech and drug sector, and that biotech sector has weighed on the market. Now, when we take a look at the advanced decline on a weekly basis, as well as volume, boy, that sell-off last week, there was very little sell-off in the marketplace from a volume perspective. So now as we take a look at the seasonality of the NASDAQ, we see that we go from about quadruple witching, which is the end of this week, down to about the middle of April. There's a sharp tendency for the NASDAQ to decline. So I'm a little concerned about that sharp sell-off in the NASDAQ from a seasonal perspective. We did form a weekly low close doji on the NASDAQ. We did form that weekly. So from here, the question begs, do we look for rallies in the NASDAQ, and maybe as if we take a look at this a little closer, as you can see, the market hit a pivot support and overnight action, and now we're coming back up. And one of the things that I think that might happen is that if we do see a seasonal time frame and the market wants to just not really advance to the upside, but yet not wait until quadruple witching to start rolling over in the NASDAQ and adhere to that seasonal tendency for a decline for the next few weeks, the question begs, do we take advantage by looking at an inverse ETF? And an inverse ETF that's relative to the NASDAQ would be QID, and it is optionable. So we can look for some optional strategies or some bearish optional strategies and take advantage of QID or potential downside action in the NASDAQ 100. The NASDAQ has, as you can see here, we've got maybe some overhead resistance that comes in on our daily charts, is right around the midpoint of these moving averages that we have. So we're talking around perhaps 3673. Without a doubt, I would not want to see the market get back above the high of Thursday. Thursday's high is as many of you may identify as an engulfing pattern, but we call it a last conditional change because it's the market that closed below past or prior lows. In fact, if the market did rally back up to the midpoint, which these moving average represents the midpoint of the open-close relationship of Thursday's range, you got a nice little pullback, snap back up to those moving averages, and therefore you may have a better shot at a QID entry, and at least identify that if the market gets back and closes over that high, all bets are off on the short side. And it reduces the risk that perhaps maybe this year we're not going to see any type of a sell-off in the NASDAQ. Because we're in a topping process, and because the April seasonality of weakness, corrections come in two forms, sideways to lower, right? So what if we rally a little bit and it's a sideways type of correction? The best strategy there would possibly be a credit call spread rather than a directional stock replacement type strategy. So I just wanted to lay that out on you guys, and we'll be watching that through the course of this week. Looking at the daily charts on the Russell, we did see the Russell, we just barely closed below this daily last conditional change candle, but remember, when we did so, this was the March contract. So this was March to March, and now we rolled over to June. So while the March contract looks pretty ugly, and when we go back, or the daily chart looks pretty ugly, when we go to a weekly chart, it's like, wow, we did get follow through to the downside, but one of the things that we didn't see is we didn't even take out, and that's what this arrow represents. On longer term analysis, we didn't even take out the lows on a weekly chart. So I wouldn't be too adamant about getting an ETF, a bearish ETF on the Russell. To me, the Russell looks perhaps the least bearish of all the indices right now. The fact is that we just came in, it's going to look like we hit my weekly moving average, but we didn't even take out the prior week's low on the Russell. So what does this look like on the cash market? And the cash market looks very similar. It had an inside range, slightly lower time frame. There's no orange arrow like there was back here in the first week of January, or the third week of January, excuse me, where we did see kind of a 2-week sell-off in the market. Over here we had a weekly sell signal, and we got another 2-3 week sell-off. Over here we had a weekly sell signal. It only was good for follow-through for 1 week, and it negated the trade. The same thing over here, but again, that's a seasonally strong period of time back last year. This year is a little bit different, whereas the market, the top action is what I'm describing, is taking, it's a process, it's taking a little bit longer to form. So the element is, from a seasonal perspective, since we do have several sectors besides biotech, we have the telecommunication sector, which is on your sheet, and some of those names are in the NASDAQ 100, will weigh in on prices. So I think that sector rotational correction is still in the works, and so therefore I think if we're looking for a hedge, at least be prepared for maybe focusing weakness on the QID, and that's where our sector analysis and looking at the seasonal analysis of sectors may help us get more bang for our buck. So looking at the QID, and I'm going to change our pages now, and let's go over to our relative strength page. And before I look at QID, well, let me take care of QID right now real quick with you guys. Okay, so as you can see, QID, wow, big volume surge according to our on-balance volume. And again, this is a daily chart. When we take a look at our weekly chart, the QID, we saw that we had a doji formation several weeks back. The high of that doji was 57.51. Last week's close, if you notice, was 57.70, 1 cent, not a high closed doji. So 57.70, we had a high of 57.51, 57.70. It was a high closed doji. Repeat, we did get a high closed doji in, I need to zing that up. This is a weekly chart on QID. So when the NASDAQ, it's an ultra short ETF. When the NASDAQ goes down, it goes up. But I think at the very least, you got to identify the fact, is this one that's going to be directional in nature to the upside, or is it going to be more of potential range bound? So what I think is on any strength this week or now, any strength, you're going to see the QID back off. And if it's going to remain firm, then the midpoint of Friday's breakout candle or engulfing paddle, near that midpoint, that's where if the market comes back down near that area, you would see it should hold. If the NASDAQ is going to be in a trading range, we don't want to see these lows taken out. So obviously, we reduce our risk by taking advantage of being in a potential trade that's going to last with the seasonality. So if the market backs off, I think looking at any optional trade, the key for me is I think a nice play or a good setup would be a credit put spread in QID for the April expiration, not a weekly, because it takes time for this to develop and you'll get theta. So for me, I'd be looking, and we will be looking for that in this trading room this week. Okay, so there's the trade for the week based off market conditions. Now I want to take a look at our sector analysis year to date and take a look at what kind of moves have we seen. As you can see, this olive is XLV, and XLV has certainly seen a little bit of correction. We just broke a prior lower low. So we are seeing the healthcare and the drug sector start to deteriorate. Looking at the KRE, it's this green line in here, regional banks are still behaving slightly bullish. Why were they so low back in February? Down almost 9%. Well, the reason is because they were up nearly 40% last year. The KRE, which represents the regional banks, was the strongest sector last year, so there was some profit taking in that sector. And now it's right back up to over 1%. So there are some values in the regional banks. This red line represents the IYT in transportation. And if you note, a lot of people were saying that transportations haven't confirmed the bull market. Well, the funny thing is transportations don't start coming into their own as far as seasonally strong sector until early March, and they did right on cue, as if someone turned a light switch on. So this is in my professional package, and it's available for the lifetime users of Genesis. And as you can see, it actually gives us not just a performance, but it shows like a racehorse what horse is leading the pack. This is utilities. It was like one of the worst performing sectors last year, and utilities sector is actually in the last week really led the charge. We were really gung-ho about utilities back in late January, mid-January, late January, which we exited and did not really, if you think about this, from the 11th, we started to see an uptick, the 12th. This particular move, we went from, it was almost a 3% move last week in the utility sector. That's more of a defensive play, but I do think there's a lot more upside in the utility sector, especially electricity utilities. If you take a look at your sheet today, you'll note that we have some weekly high closed dojis. I want to cover those in just a second. Next, I want to really look at our McClellan oscillator. One of the things that we note in our trading room is that we were kind of a little bit skeptical and nervous that we would see a little correction in the market, and yet that's where I think the sector rotational theme correction has been helpful. So rather than get ultimately bearish, load up on puts, get directional on this move, we've been very cautious on the downside. And for stock trading, we've been very selective in what stocks we want to look at. I think what we want to start to see is being in seasonally strong sectors, number one, and some of the best looking stocks in those sectors as far as a stock trader's perspective is. As far as day trading in the market, as we all know, we have to be kind of looking around at maybe other trading opportunities, because what's happening is, folks, we get a lot of moves overnight. You get a first blast, first thing in the morning, right after the open, and then you get this noon balloon or noon swoon, and most people are not conditioned to be trading at those particular hours, the first 15 minutes of the open outcry session, and of course the lunch hour. And those are when we've been seeing distinctive moves. So it's like the hedge funds kind of stealing the glory, the professional traders stealing the glory from the retail speculators, who for years have been taught, don't trade those time frames. It can be choppy. That's been my keen observation. So we've been looking at other trades and to help pay our way, so to speak. Bean oil, for example, live cattle, for example, crude oil day trades, for example. So we look for intraday setups there in the room on a daily basis. And again, I'm looking at my potential support and resistance targets in the S&Ps. With the market here in the S&Ps compared to the spiders, while on a daily basis we crossed over this little moving average, and typically when we see those moving average crossovers, we see periods of corrections in the market, like you see back here in December, like you see back here that occurred in January, like you see back here, which occurred in September. But the difference is the level of which the McClellan oscillator is at was already starting to decline, and in an oversold condition, not an overbought condition. So now when we take a look at a weekly chart, we're actually net neutral. We're neither overbought nor oversold on the McClellan oscillator. So I think that's what is another factor that gives me confirmation that we're going to see maybe a sector rotational grind in the market rather than an overall net decline. On a weekly basis, we haven't even crossed over that moving average. So I can't get ultimately bearish on the market and say, throw the baby with the bathwater out the window. Let it all go. I can't say that because I don't have longer-term evidence. And this has got nothing to do with our weekly PPS indicators. And the fact is, I'm using multiple non-correlated indicators to come up to the same kind of conclusion in the marketplace. This is looking like to be more of a sector rotational grind, and that we're going to continue to see weakness in NASDAQ-related indexing rather than broad-based indexing. And the NASDAQ has a slight effect on the S&Ps. So the S&Ps, while we do have, all the sectors contain transportation stocks are in the S&P 500. There is, while we do have an effect of NASDAQ and technology and drug stocks, you also have some other industrials and materials and all kinds of other sectors there to help support the S&Ps. What might happen is that the S&Ps don't fall, they just don't really go up much. And so therefore, the NASDAQ is probably the best play from a credit, and then I think the QID is a smart way to play that market. And I think probably one of the best risk-reward setups that we can look at for the next 2 to 3 weeks out, okay? Especially as we head into quadruple witching with all the events that we're faced with. From looking at the market here from the beginning of January, let me get back up here real quick. So from December 31st, the end of the gold has really, and as we've been in, as I mentioned, a seasonally weak period of time, and if gold's rallying in a seasonally weak period of time, I can't imagine what it's going to do in a seasonally strong period of time. It has surpassed all the other markets. The other markets here we look at are, like, for example, even bonds right now from a, if we take a look at a 0% net change, so to speak. So there's 0% right there. So bonds are still positive. They're up 0.4% for the year. We look at the Russell is still positive, up 0.2%. If you look at the NASDAQ, which is black, is only up 1% of the year and falling off. That's why even looking at a relative performance in the market, the NASDAQ could see some negative performance, or if we do get up and rally a little bit into this, I think maybe another 1.5%, which equates to those moving averages I was talking about in the NASDAQ. If we get up in there, you can always look for the rollover and then jump on that QID, as well as looking at a credit put spread on QID. But I'm using my relative strength analysis to say, what does the overall market look like? Where's the strength? Where's the weakness? We have the euro not doing a whole lot of anything. The S&Ps are unchanged and slightly negative. Looking at the Dow over here is slightly, obviously, negative 3% on the year. So what this information does in this gray line is the Japanese yen, which you can see the yen actually mirrors the bond pricing. It really is an amazing tool that helps illustrate what we've been saying for 30, 40 years, that yen, as goes the bond, so goes the yen. So in price terms of futures markets. All right, so I think I just wanted to go through and walk you guys through some of the analysis of what it brings and where we're coming up with some of our seasonal trades. When we take a look at our sheet, and I know the market just opened up here for stock trading. First off, let's take a look real quick at CNX. We have a during this time frame, CNX is coal and consumable. It formed a low closed doji. And one of the things that I think is extremely notable is, as you can see this rally in the market, if you take a look, and I'm not sure what this is going to tell you, but that's the volume histogram, but I can certainly tell you what this tells me, and that's on balance volume. While prices is going up, and while we are in a seasonally kind of, I guess, uptrend in the market, the fact is that in the consumable coal sector, as you can see, from January, it really doesn't even begin a strong seasonal time frame till about the end of March into the 1st of April. With that said, I think this is a stock that is not performing very well on this rally. There's no volume associated with it. And so when I look at some seasonal weakness for the next few weeks, I say, geez, what's the rest of that sector look like? Coal stock still does not look great. Let's take a look at CRM, because these are weekly low closed doji. I want to also point out that I scan for not just weekly low closed dojis, but weekly low closed dojis with poor volume. And some of these names are at not just a monthly pivot resistance, quarterly pivot resistance. So CRM, and I'm sure most people know Salesforce, has had a heck of a ride to the upside. Look what the seasonal trend is from March to about July. It's not up. It's more flat to down. Does everyone see that? So this could be on any strength this week, and up to the weekly moving average near $60. If you do get a dollar, some type of a pop off of the monthly support, the quarterly resistance targets with those weekly low closed doji might give us some type of a setup on a short side. I'm just wanted to go through some of the names that I think are in sectors that don't perform well this time of the year. This is Oracle, and as you can see, I mean, it's not until May that it has little slight uptrend. So it has a seasonal weakness in Oracle. It did form a low closed doji. The weekly volume on this rally wasn't all that bad, but the daily volume isn't all that good. So Oracle is a name that I think earnings is out on the 18th. So that's tomorrow, of course. So one of the things that we want to do is, if they have a pop, possibly this is one that, maybe they're going to surprise, because this whole sector has been kind of fairly bullish. But this volume action with newer highs, you have newer highs, and there's been no market participation in the volume. I'd be really concerned on, if I was already long this market, I'd be taking something off the table, but I don't want to bet on an earnings binary play. Is it going to beat, exceed, go up, go down the expected moves per strangles that you can look at on options, put, and calls? I'm just looking at this market that maybe if it does have a pop, I'll take advantage of that pop to to after earnings take a credit call spread for April because the overall trend's to the downside. To me, that's a better use of my money. Why get into some of you guys are more aggressive traders and you want to be looking, if that's if that's your game plan to trade weekly options on earnings plays, then that's your it. But here's some names that could generate some performance for you. Looking at ORCL, I meant ISRIG, ISRG, real quick, ISRIG, here we go. ISRIG, boy, not a very strong seasonal trend headed into April, and boy, while this market tried to bottom out and get into this rounding bottom, it did a nice job, but if that's all it can do, any strength this week, looking at the daily on-balance volume action, boy, nice try to the upside, but note that there was no volume associated with that upside move. So if you do get any inherent weekly strength this week near maybe 438, that would to me be more of, and as you can tell, you're gonna have a real hard time getting up to that 438. We do have a low closed doji. 438, it's more like maybe 435 area, 433, something like that. And your risk, 434, maybe up to here, 433. You want to watch ISRIG for a move up there against that area for a spike. And if it gets up in that area, I'd look at maybe a bearish option strategy. The last thing you want to see, though, and I would do an option bearish strategy for the month expiring in April. I do not want to see the market get above that high, which is 444. So downside action could easily come back into not to test this low, but to rather test the area in here, which is around 378. It's easily attainable by the April expiration, which would be somewhere, 388, somewhere in 380, 390 zone would be fairly reasonable expectation. Ultimate downside would be to test these or the next quarterly pivot support, which, by the way, next week, planning and scanning is not just a new week. Next week is a new quarter. So next planning and scanning is going to be a very important planning and scanning. We'll be a little bit more prepared for listing of new sectors. As you can tell, we talked through the end of March, and it's not just the end of March that we have seasonal, but it's also the new quarter. So this next quarter is going to be very vital. We'll have new quarterly projections based on our pivots. Anyway, I wanted to go through the planning and scanning with you guys to talk about the potential weakness in the market. I think especially in NASDAQ related and where the weakness in NASDAQ is coming from. With that said, that concludes our time together for this morning's planning and scanning. I know we went a little bit 8 minutes over, but there's, again, with planning and scanning, a lot to cover here. So thank you all very much for attending, and for those who will be watching this in the rebroadcast, don't forget, if you can make it here Monday next week, it should be quite an interesting scan as we go through the charts for new quarterly analysis. Thank you all very much.